Alright, awesome. So now let's talk about what can be done with you. Let me show you how the system works and you can see for yourself if you want to apply it. Cool? Deal? Alright, let's do this. First, let me tell you some truth about the forex market that brokers and experts don't want you to know. So let's talk about the truth about trading. Here's the ugly truth that you will never hear the gurus or most experts talk about. Truth number one, 90% plus of people who get started with trading fail. Okay? Let that sink in. 90% plus of people who get started with trading fail. You might be asking why they fail. Everyone tells you how easy it is to make money trading forex online, when the truth is it's harder today than it has ever been before. Anyone who tells you otherwise is lying to you. Many reasons of failure. First, we have they are not clear about their goals. They don't know exactly how much they want to make. The second reason is they don't follow the right action plan. Okay, they are all over the place. The third reason is they are stuck in learning mode, so they don't take massive action and work their asses off. And the fourth reason is they are not persistent. They don't keep going forward when they hit the inevitable roadblock. And the fifth reason, last but not least, they don't know how to apply the 4 pillars. Alright? Truth number two, there is a lot of noise and misconceptions in the trading market. I want to make everything crystal clear to newbies and intermediate traders who are still looking for answers on how to become consistently profitable. Okay? Truth number three, brokers prefer that you don't make money. That's right. The brokers are taking the other side of your trades. That means there's a lot of conflict of interest in the industry when you are a retail trader. There is obviously the commission situation and the spread situation. Just because spreads are tight and commissions are low doesn't mean it's a good thing, because all that means is that the brokers are going to try and turn your account over more aggressively so you pay them as much money, so they'll be telling you to do things that aren't necessarily good for you. You cannot trust banks, you cannot trust institutions, they make money from you losing. Okay? Truth number four, you can't rely solely on indicators. Okay, does this sound familiar? Have you ever relied solely on indicators such as stochastic, RSI, MACD, etc.? And then did you find confusion when you placed a trade according to the indicator signal, but the market went the other way and you ended up losing? I know it sucks. I'm sure you have been there. I can relate. Okay? Truth number five, the number one reason 90% of traders fail is believing all the BS in the marketplace. So again, we're back to this conflict of interest. A lot of either bad people or people who are incentivized to tell you lies. They will tell you things that you want to hear all the time. You know what people want to hear about trading, that everyone can do it, it's easy, and you can make 10K a month trading the international forex markets if you follow this indicator on a chart. Complete nonsense, okay? So a lot of these people with companies of different interests will tell you that stuff, but it's obviously a lot more difficult than that, okay? Trading can be straightforward, but you've got to understand and master the 4 pillars in order to become profitable consistently in the long term, okay? For example, what most people do when they begin trading and they've never done it before, that's right, they sit down on their computer at home, type into Google, learn how to trade. And what comes up first? Well, on the SEO, on the left-hand side of Google, it's all brokers, and they have all got a conflict of interest. And on the right side, on the right-hand side, you've got paid search, where people are paying for you to click on that. Why? Because a certain percentage of people who click on that pay them enough money that they can do it again, right? So you've got to be careful. You're not going to learn how to trade by going onto Google, typing and learning how to trade and going through 20 courses or 20 free seminars. What you're going to learn is a lot of rubbish that will never make you money, and then everybody goes and puts money in their trading account and blows up, and they wonder why. And then they sit there for years, save up some more money, and then they do it again, and they never actually seek out a proper education. What you need is proper education, okay? So now let's talk about the 5 biggest mistakes traders make and how you can avoid them. So mistake number 1, I'm going to list the mistakes, and then I'm going to explain each mistake in more details. Okay, so mistake number 1 is taking unplanned trades. Mistake number 2 is not using a proper risk management, or we call it over leveraging. Mistake number 3 is jumping trading strategies, which means you go from strategy to strategy hoping you find the holy grail, which you'll never find. And mistake number 4 is taking losses. Most traders don't know how to take losses, how to react when they take a losing trade. And mistake number 5 is over trading. Okay, so these are the 5 biggest mistakes that most traders make that cause them to fail at trading. The desire to make money overnight, okay, is at the heart of what causes traders to fail. Not following the 4 pillars is the number one reason most traders fall into these mistakes. So now let's explain each mistake in more details. Okay, so let's start with taken unplanned trades. Very often traders take on trades often linked to the feeling of missing out. Alternatively, traders will take a planned trade and modify it throughout the trade. How many times have you done that and regretted after that, and had you stuck to your original plan, everything would have been fine. The more thinking and planning you put into your trades, the more consistent the outcomes will be. Don't second guess yourself. Okay, so plan the trade and then execute the trade. Don't react to whatever happens during the trade. Okay. Mistake number 2 is not using a proper risk management or over leveraging. Traders often want to begin trading by starting off a small trading account, however, they still want to make big money. This does not work. If you have a $500 account, you're not going to make $5,000 per month in your first month. Okay? Many traders think it's acceptable to risk 20% of their account on any one trade. The problem here is when faced with several losing trades in a row, for example, three losing trades in a row result in 60% of their account being lost. Risking high percentages of your account result in account killing drawdown. So never do this, okay? Imagine if you lost 6% of your trading account, you then need to make a 175% of your remaining account back to get back to where you first started. Okay, so it's very, very important to use proper risk management. Okay, investment banks, hedge funds, and professional traders only risk a small percentage of their account per trade, which is roughly between 1 to 5%. Okay, if you want to avoid catastrophic drawdown from your trading account, only risk 1% to 5% per trade. Okay. Now let's talk about mistake number 3, which is jumping trading strategy. And this is one of the most common mistakes that I see all over the place. Okay, so trading strategies need time to work for the expectancy of the system to play out. A failure to understand the statistics and probabilities causes traders to abandon a trading system or trading strategy after a few trades if they aren't winning trades. A trading system or strategy cannot properly be evaluated without sufficient number of trades have been taken. So look at your trades as a sample size of at least 100. Yes, you heard that correctly. Look at your trades as a sample size of at least 100. Don't focus on one particular trade. When trading a new system, use a small amount of leverage and risk and give it time to work out. You can always increase the leverage at a later date. Okay? Mistake number 4 is taking losses or not knowing how to take losses or how to react when you take a losing position. The ability to take a loss will make or break traders. Professional traders know this, okay? They know that taking losses leads to greater profits. They understand that losses are part of the game and they don't overreact or change their trading strategy. They stick to the system knowing and believing that they will end up with profits at the end of the month. Okay, so if you think that there are no losses in trading, then you need a reality check. Okay, think of losing trades as costs of doing business. All right. We are not naturally built to take losses, which make us feel bad about them. So human beings, we're not naturally built to take losses. So you need to recognize when a loss makes you feel bad and take appropriate action. You need to avoid adding to losing positions, moving stops to avoid losses, and revenge trading to try and make up the money, which lead us to mistake number 5, which is over trading. Most traders overtrade. The fear of missing out on a move in the market and the constant temptation to revenge trade to recoup your losses causes traders to take too many losing trades. Okay? Less is more often applies to trading, and this is very much the case when deciding how many trades to take. Okay? Very, very important to avoid, that temptation to revenge trade because you had like a losing trade. You need to recoup your losses very fast. That's the recipe for disaster, okay? We only have so much energy and focus to trade. Overtrading causes us to trade when we are not in the best state of mind, okay? In order to do so, this can lead to trading errors and costly mistakes. You need to know this. You do not need to be on every move in the market. The market will always be there. The market will always be there and there will always be opportunities, okay? Your priority should be focusing upon taking a selection of high quality trades, all right? Now you've learned the 5 biggest mistakes most traders make. 1. Taking unplanned trades. 2. Over leveraging. 3. Jumping trading strategies. 4. Taking losses. And 5. Over trading. If you have the ability to overcome these 5 biggest mistakes, then you give yourself a great chance in trading success and making the profits you always want to make. Okay? Alright, awesome. So what I'm about to share with you now is seriously going to change the way you look at the Forex market forever. What if there is a way to predict the major moves in the market simply by looking at the chart? Would you be interested to know? Since I discovered the 4 pillars, my trading career changed, and I became determined to succeed in this business no matter what. This is what happened. I realized one important factor. If I was to succeed in this business, I had to keep it as simple as... So now I'm going to skip the fluff. I'm here to tell you right now that you need to know 4 things in order to be a consistently profitable trader. Without one of them, you're just not going to be successful. Okay? My hope is that you get closer to your trading goals. Okay? So now let's talk about the 4 pillars of profitable trading. Are you ready? I'm going to list the 4 pillars and then I'm going to explain each pillar in more detail. So let's get started. Pillar number 1 is you need strategy with an edge. Pillar number 2 is proper risk management. Pillar number 3, consistency, the law of large numbers. And pillar number 4 is psychology. So again, strategy with an edge, risk management, consistency, the law of large numbers, and psychology. So pillar number 1, trading strategy with an edge. You need to have a trading strategy with an edge. Pillar number 2, proper risk management. You need proper risk management. Only use 1 to 5% of your trading capital per trade. Pillar number 3, consistency or the law of large numbers. You need to be consistent with your trading strategy, at least 100 trades. Take advantage of the law of large numbers. And pillar number 4 is psychology. You need psychology, or otherwise known as discipline, when you hit the inevitable losses. Okay? You need these 4 pillars together in order to become a professional, successful trader. Okay, learn them by heart. Okay, and you'll see in a minute why they are important to work together. So again, the 4 pillars of profitable trading: we have strategy with an edge, proper risk management 1 to 5%, consistency, law of large numbers, 100 trades, and psychology, stick to the plan when you hit the inevitable losses. So let me walk you through the following different scenarios to understand the importance of the 4 pillars working together. So scenario number 1 is the importance of a winning strategy with an edge. Let's say I give you the best risk management. You're using the best proper risk management, you're consistent with your trades, and you have the best psychology. Do you think that you can be consistently profitable trader in the long run? Well, let's walk you through a simple example. Let's say you are going to a casino and you're going to gamble. You have the best risk management, you are consistent, and you have the best psychology. Do you think that you can make money from the casino in the long run? The answer is no. Why, you might ask? Well, that's because the casino clearly has an edge over you. You don't have an edge over the casino. So you can have the best risk management, you can be consistent with your trades, you can have the best psychology or discipline, but you are still going to lose to the casino. Okay, same thing with trading. If you have the best risk management, you're being consistent with your trades, and you have the best psychology, you will end up losing. Why? Because you don't have a winning trading strategy with an edge. The point I'm trying to make right here is you need to have a winning strategy with an edge to be profitable on the long term. To put it simply, an edge is a positive expectancy whereby if you keep doing the same thing many times, you will come out ahead or in profits. So this is the formula right here. Okay, remember this. Positive expectancy equals probability of win times the average win minus the probability of loss times average loss. So the probability of win is the edge. So for example, if you have a strategy that lets you win 60% of the time, times the average win, that means the risk to reward ratio. Okay, so for example, if you're risking 1 and your reward is 2, okay, so that's 60% times the average win, okay, minus probability of loss times average loss. So for example, let's say probability of win 60%, the average win is 2, so 60 times 2 minus probability of loss, which is 40%, times 1, okay, and you'll get what, 120% times 40, so that's 80%, okay. Scenario number 2 is the importance of using proper risk management. So now let's say you have a winning strategy, which is pillar number 1, and you're being consistent with your strategy, which is pillar number 3, and you have the right psychology in place, which is pillar number 4, but you don't have a proper risk management, pillar number 2. Imagine you want to go bigger, right, because you want to make money fast, and then you encounter a series of trade looking like this: loss, 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 loss. then win. You have a trading system that wins 50% of the time with 2-to-1 risk to reward ratio, or 1-to-2 risk to reward ratio. And you have a hypothetical outcome of lose, 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 win, 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 win. It's a profitable system, right? Well, it depends. If you risk 30% of your equity, you would blow up by the fourth trade. So let's say you 30% of your capital, or of your equity in your trade. So 4 times, okay, let's say you have like four losses in a row. So minus 30, minus 30, minus 30, minus 30, that equals minus 120. Your trading account is wiped. See why it's important to have the proper risk management? But if you risk 1% of your equity, you would have a gain of 4%. Here's why. Minus 1, minus 1, minus 1, minus 1, plus 2, because if you remember, we have 1-to-2 risk to reward ratio, so plus 2, plus 2, plus 2, plus 2. That equals plus 8 minus 4%, and that equals 4% gain, or 4% profit. Having a winning system without proper risk management isn't going to get you anywhere. You need a winning system with proper risk management. Okay? Winning trading strategy plus consistency plus psychology are not enough. Clearly by now you should understand it. Without proper risk management, you're not going to go very far either, right? So if you risk 1% of your equity, you'd have a gain of 4%. Again, minus 1, minus 1, minus 1, minus 1, plus 2, plus 2, plus 2, plus 2 equals 4%. Okay, so always use proper risk management. Here's a statistic right here to emphasize my point. So let's say the percentage of loss capital is 10%, and the percentage of gain required to recover the loss is 11.11. If you lost 20% of your capital, you need to recover 25%, 30%, 42.85%. If you lost 40%, you need to recover 66.66%. If you lost 50% of your capital, you need to recover 100%. 60% you need to recover 150%, 70% you need to recover 233%, 80% you need to recover 400%, 90% you need to recover 900%, and of course if you lost 100%, you're broke. Okay, so very, very important, very crucial to use proper risk management. Now let's move to scenario number 3, which is the importance of consistency and the law of large numbers, and this is one of my favorite scenarios. So now let's say you have a winning trading strategy and proper risk management. Is this enough? Chances are you will make money in the short term. However, what happens when the drawdown comes, when you start having a series of losses, when you're going to abandon that trading strategy altogether and jump into a new strategy and stop being consistent because you start doubting yourself and think it was just luck. And this is one of the most common mistakes traders make, okay? Once they have drawdown or a series of losses, they jump into the forums, they choose another strategy because they think that there is out there a winning strategy that lets you profit all the time, which is a lie, which is an illusion. Okay, there is no holy grail. Okay, the holy grail is to use the 4 pillars together. Okay, so you start to find something else, so you hop onto into another trading strategy and you start the entire cycle all over again, and you are forever trapped in this cycle. Okay, so a winning trading strategy with an edge plus risk management are not enough. You need to be consistent with your trades and let the law of large numbers to work in your favor. A great example is the casino business, where the house has a few percentage points advantage over the player, called an edge. The house cannot guarantee it will win the next hand, but is certain that it will win over the long run. This is why you see year after year casinos are very profitable despite not knowing whether they will win the next hand. Why? Because they take advantage of the law of large numbers. By having an edge, you also need the law of large numbers for your edge to work out. Having an edge doesn't guarantee you will be profitable in the short term, but it guarantees that you will come out ahead over the long term. This is why casinos are profitable every year, because they play thousands if not millions of hands with an edge over the players. This goes the same for trading. If you have an edge in the markets, you too need to allow the law of large numbers to work in your favor to be profitable. That's why I advise to at least use the strategy for 100 trades. Okay, so now let me show you this example right here to illustrate my point. So here's an example of 100 trades, okay, executed with a starting capital of $1,000. with a trading strategy that wins 60% of the time with 1 to 2 risk to reward ratio and 5% risk management. So here we have the first pillar, which is a strategy with an edge, 60% winning strategy with 1 to 2 risk to reward ratio. We have also pillar number 2, which is risk management, 5% risk management. We have also pillar number 3, which is consistency, the law of large numbers, 100 trades. And we also have psychology, that means not deviating from the plan. Okay, so as you can see here, the target return here is 200%, the loss limit is 100%. That means risking 1 to 2 risk to reward ratio, we're willing to lose 1 and we're willing to win twice as much. The probability of loss is 50%. Okay, but here the numbers of wins is 60 and the losses are 40, so 60%. The starting amount is 1,000 and the invested per trade is 5%. Okay, as you can see here, number of wins 60, number of losses 40. The high value, this is $39,000, 130. Low value is 1,000, and the ending amount a whopping $39,000, 130. Okay, that's nearly 40K. Okay, after 100 trades. So as you can see here, okay, so individual trade results. So for example, when you start with 5% of 1,000, 5% of 1,000 is $50, okay, times 2, that's 100. That's why we have a profit here of $1,000, 100. And then the second trade was a loss, okay, and you keep doing the same thing. Okay, so the current amount, okay, times 5%, okay, to get the amount of you're willing to lose, okay. And after 100 trades, what do you know? $39,000, $130. This is the power of using the 4 pillars working together. Okay, guys? That's why it's very, very, very important to have like a strategy with an edge, risk management, consistency, law of large numbers, and psychology. Okay? Disclaimer, again, results are not typical. This is just an example to show you what can be done with a winning strategy with an edge, plus proper risk management, plus consistency, 100 trades, plus right psychology. Okay? So instead of trying to find something else or jump onto another trading strategy and start the entire cycle all over again and forever being trapped in this cycle, you just need to be consistent with your trades. A winning trading strategy plus risk management are not enough. The point here is you need to be consistent with your trades and let the law of large numbers to work in your favor. Alright? I hope you get this. Now let's talk about the last scenario here, which is scenario number 4, the importance of having the right psychology. Okay, now let's say you have a winning strategy with an edge, plus proper risk management, plus consistency with your trades. What else is missing? That's right, psychology. People may learn the right trading strategy, they may have the right risk management in place, but they still can't make money. Why? Because the majority of your success is your ability to produce consistent profits, which you get from proper psychology. I'm gonna say that again, because the majority of your success is in your ability to produce consistent profits, which you get from proper psychology. Psychology refers to your psychological discipline to follow the trading system consistently with no deviation, and that's one of the most difficult things that people are not able to do. Unless you have the right mental training or the right mental skills, you won't succeed with trading. Again, unless you have the right mental training or the right mental skills, you won't succeed with trading. So what happens to most people when they get 5 or 6 or even 7 losing trades in a row? That's right, they freak out, they get upset, they take it personal, they get emotional, and that's when they start to intervene in a trading system. They begin to make these mistakes. Again, the 5 mistakes we talked about earlier: take unplanned trades, over leverage their risk, jump to a different trading strategy, over trade revenge trading, or they can do mistakes like remove their stop loss. They begin to take profits early because they're afraid. They begin to abandon a trading strategy and they use another trading system in place, and the list goes on with bad decisions. Why? Because they can't control their emotions, they can't master their emotions, they don't have the right psychology. You see? That's how most people will never become successful as traders, because of their inability to manage their emotions in following the trading strategy. Okay? It is only the outcome over a larger statistical set, which means over 50 to 100 trades, that result in consistent and predictable profits. Again, I'm going to read that again. I underlined this to make it important for you to emphasize this point. It is only the outcome over a larger statistical set, which means over 50 to 100 trades that result in consistent and predictable profits. So at the micro level, the outcome is random and unpredictable. But at the macro level, okay, and the larger things, in other words, over 50 to 100 trades, the outcome is predictable when you have a statistical edge. Okay, see what I mean? So we are back to trading like a casino. The casino knows that at the end of the year they will always make money. Why? Because when a casino plays, they have no idea which hand will win and which hand will lose. They keep following the same strategy with an edge because in the end they always make money. Okay, so my point here is you need to have the right psychology and mindset, which is the discipline to follow the trading system consistently with no deviation. Okay, I hope you get that. Alright, so now let's talk about how the winning and losing traders respond differently to losing streaks. Okay, losing streaks means the series of repeatable losing trades. Okay, so remember, it's not what happens, it's how you choose to respond to it. So when we get a losing streak of losses, which will happen, most traders lose confidence in that system, or they blame themselves and their luck. They say, oh, there's something wrong with me, I've got bad luck or whatever. Okay. Struggling traders want to avoid losses. Pro traders accept losses as being part of the game. Okay. In fact, they love it. Okay. It's simply the cost of doing business. So what do pro traders do when they face losing trades? That's a good question, and the answer is winning traders, when they go through the inevitable losing streaks, they accept that it's a part of the game and they have confidence in their trading system, which is the positive expectancy we talked about. So as a result, they can keep executing trade setups consistently, okay, because the losing trade brings them closer to the winning trades. Okay, so to summarize the 4 pillars to profitable trading, first we have the first pillar is you've got to have a good trading system, plan, strategy with an edge that fits your personality. Pillar number 2 is you got to have a proper risk management, only use 1 to 5% size of your positions. Pillar number 3 is you got to be considerate with your trades, even with losing trades, 100 trades. Okay, let the law of large numbers to work in your favor. And last but not least, pillar number 4, you got to have the right psychology and react to losses as a part of the game, not being affected emotionally, and don't change your rules. So these are the 4 pillars: strategy with an edge, proper risk management, consistency, law of large numbers, and psychology. Okay, I want you to learn them by heart. Okay. Now let's talk about the trader's life cycle. And I like this photo right here. This is like the evolution, if you will, or the life cycle of the traders. So I'm gonna list the 4 stages of the life cycle, and then I'm going to explain each stage in more detail. So let's start with the newbie stage. Then we have the hurt stage, third stage is the expert stage, and the fourth stage is the pro stage. So again, newbie stage, hurt stage, expert stage, and the pro stage. Let me walk you through a very typical trader's life cycle. So the first stage is what I call the newbie stage. This is where you focus on the trading strategy only. You're looking for the holy grail of trading. Jumping from forum to forum, reading threads, books, watching videos, buying courses, all focusing on the strategy. And then after you use the strategy and you start losing money and you realize that strategy alone is not enough, this is where you are promoted into what I call the hurt stage. And everyone, okay, even like everyone goes through these 4 stages. Okay, I remember when I first started, I was at the newbie stage. I didn't even care about risk management. I used a strategy. I jumped into another strategy, and I put maybe 50% risk, risk management. I know that was awful, but I was like, hey, if you wanna win big, you gotta risk big. You know, like high risk, high reward kind of mentality. But then you get a lot of losing trades, and that's how you learn, right? So don't do the same mistake unless you want to lose a lot of money. Okay, so now let's talk about the second stage, which is the hurt stage. As a deeply hurt trader with unexpected losses, you realize that strategy itself is not enough. You also need proper risk management. So at this point in time, you are still looking around at different strategies, but your focus is not entirely on strategy. You also start understanding the importance of risk management, 1 to 5% of your capital. Well, here you need to find the percentage of risk on each trade that you are comfortable with, okay, which is 1 to 5%. Then I will say a lot of traders are stuck at this stage. Why? Because of the fact that they are not consistent in their trading strategy. They don't have the discipline to stick to the rules that have set up for themselves. So maybe they have a trading strategy and proper risk management, and when they face losses, they abandon everything altogether and they go back to research for new strategies. Okay, a lot of traders are in this vicious cycle for a very long period of time, and only a selected few, the top 10%, would make it to the stage which I call the expert stage. This is where you have a trading strategy that has an edge, plus you have proper risk management, okay, plus consistency in executing your trades, which is a great place to be, the expert stage. You will have more consistent results, but you still need the right psychology. Let's say you take some losses and you overreact and do one of these 4 mistakes. Again, we talked about these mistakes. You take unplanned trades, not following your winning trade. 2, you over leverage, not sticking to your risk management and attempt to recoup your losses, which I call revenge trading. 3, you jump to another system. And 4, you over trade. Okay, you see, to become a successful trader, you need to stick to the 4 pillars, and that's when you become one of the selected few right at the top, 1%, and reach the final stage, which I call the pros stage. So welcome to the pro profitable trader stage. This is where you have 1, winning trading strategy that has an edge, 2, proper risk management, 3, consistency executing your trades, and 4, the right psychology, not overreact when you hit the inevitable losses. They are just part of the game. I know this is easier said than done because once you start trading and you start losing money, okay, you get emotional, and that's where you start making bad decisions. Okay, again, human beings are not built to get losses, especially when you are so attached to money. You know what I mean? That's why you need to have the proper education in order to master your emotions. Okay, and that's why you need a coach, and that's what differentiates the pro trader from the other traders, guys. Okay. The pro traders have the right psychology. Even in times of drawdown, when they are losing, they still have conviction that they are trading a proper strategy and still follow their rules, and they overcome the drawdown it comes. I believe psychology is the hardest to figure out, the hardest to master. Finding a strategy with an edge can be difficult, but don't worry, I will give you one strategy that I use myself. It has an edge over the market. And then why is it traders are suffering? Why are they not profitable? Well, because they are not consistent with their trades and don't have the right psychology. They don't believe that the strategy works. And of course, you need to basically go through these 4 different stages for traders' life cycle. Okay, so to sum up, as a newbie, you focus on strategy, then you get hurt and focus on strategy and risk management. Then you realize you need to be consistent with your trades and risk management. Then you master your emotions and psychology and become a pro, consistently profitable trader. All right, cool. Okay, so now let's talk about the most important asset in your trading business. Okay, and I see a lot of people don't talk about this, okay, which is crucial in order to become a profitable trader, okay, and to, of course, grow as a trader. The most important asset in your trading business is your trading tracking journal. Okay, you need to track your progress. Okay, so how can tracking help you with goal setting? Good question. Answer: it helps you stay focused. A lot of people I know fail to accomplish their goals, not because they lack the skills, but because they lose sight of what they want to achieve. Tracking helps you to focus on the important things you need to do in order to move toward your goals. Okay? If you don't track, you're more likely to focus on your failures. Tracking will tell you which activities give you the best results. Aside from tracking the steps you've taken to accomplish your goals, you should also track the results from each step. After a few weeks or a few months, you'll start seeing a pattern that will show you what actions work best for your goals. After that, it's just a matter of adjusting your goal setting plan and concentrating on the tasks that yield better results. Okay? Doing this will make things easier for you. It might even help you achieve your goals faster. Tracking and data analysis allow you to record your trades. You can see what you did right and what you did wrong. Most importantly, it allows you to improve trading as long as that you review your trading tracking journal. A trading journal is a record of all your trading activity. It is important to keep an accurate record of your trading results because they allow you to assess the overall performance of your trading decisions and how effective your strategy is. This information can prove critical, especially when you start to experience negative trading results. Remember, there is no failure, only feedback. And the tracking journal will help you get data and feedback so you can improve your performance. It is the key for Forex trading consistency and long-term profitability. Okay? Here's why it's important to develop the habit of maintaining a trade journal and its benefits to your trading psychology. A complete trading journal not only contains the pertinent trade details such as entry and exit prices or the number of pips gained or lost, but it should also indicate notes on your trade decisions. This covers trading psychology details such as your confidence in taking the trade setup, your reaction to expected and unexpected market events, your decisions midway throughout the trade, and the rationale for those. Okay, by keeping track of these, you can gain better insight on how your emotions and mindset are influencing your trading performance. Okay, so now let me show you my trading tracking journal. So as you can see here, these are the elements that I track. Of course, the number of trade, then the date, starting capital, okay, risk invested, percentage of risk invested per trade, the dollar invested per trade. We have the currency pair, for example, Euro USD. We have the strategy, for example, here the support resistance bounce, and the position long or short, buying or selling, entry price, reason for entry, the stop loss, okay, the reason for stop loss, take profit number one, reason for take profit number one target, take profit number two, reason for take profit number two, win or loss, profit or loss pips for trade number one, profit or loss pips for trade number two, profit or loss pips total, and the current amount. So these are the most important metrics that I track in my trading business.